Welcome back. Now, we will proceed with the second session for this morning, panel discussion. We are honored to have 5 experts with us. They are Dr. WANG Tao, Head of Asia Economics and Chief China Economist of UBS, Dr. Helen QIAO, Chief Greater China Economist and Head of Asia Economic Research of Merrill Lynch Asia Pacific Limited, Aidan YAO, Senior Emerging Asia Economist, AXA Investment Managers Asia Limited, Dr. David Wang, Chief China Economist and Head of APAC ex-Japan Economics, Credit Suisse Hong Kong Limited, and Dr. Zhihuan, Chief Economist, Bank of China Hong Kong Limited. Because Dr. has a meeting in the afternoon, so we will first invite Dr. WANG Tao to speak, followed by Dr. Helen QIAO, and then Dr. and then Aidan YAO, and then Dr. David Wang. So now let's invite Dr. WANG Tao to speak first. Thank you very much for HKIMR for inviting me to join this conference on Chinese economy. I always attend this conference. I am grateful for this opportunity, and I'm happy to have this offline-online chance to do this sharing. My PPT is in English, but I will speak in Chinese. So to talk about prospects and outlook of the Chinese economy, there are a lot of topics that can be shared, but I will talk about the dynamic of next year's economy and also the downward movement pressure. Maybe you are all interested in the property sector and also related policy changes. So talking about Chinese economic growth, well, this slide is a bit busy. So this year, in the first 3 quarters, economic growth is not very even. So there are strong and weak parts. Export is strong, and then investment in manufacturing is also strong. Consumption is relatively weaker. And then for the property sector, it was strong in the beginning, but in Q3 there was a decline, and as a result, there is downward pressure. So overall speaking, for Q3, or actually if you look at the downward economic movement, there are a few pressures. First, the pandemic. So under the pandemic, there are a number of measures affecting consumption. The pandemic is not over yet. In the property sector, there is apparent decline. And then in September, there was shortage of energy and power outage. And as a result, industrial manufacturing was affected, and in the first few quarters, fiscal policy was tight, so infrastructure investment is weakening. In Q3, the decline is even sharper than in Q2. Looking into the future, what will be the change? Concerning the downside pressure, well, there will be change in the coming few quarters. Export is very strong. In 2022, export will continue to be strong, but not as strong as this year. Export will still be a positive contributor to overall economic growth. For consumption in the coming few quarters, there may be volatility. Our estimate is that right now, concerning pandemic control measures, well, Q4 will not be more relaxed than Q3. And then I think Q1 next year will even be tighter because of the Olympic and the CNY. So in the coming 2 quarters, consumption is still weak, maybe weaker than Q1. And then in Q2, if you look at the anti-epidemic measures, there may be some relaxation. So starting Q2, there would be obvious improvement in consumption. For energy shortage and also power supply limits, the situation is improving because supply of coal is increasing, demand is weakening, and there is decline in the property sector. So concerning upstream supply of concrete, cement, and so on, well, because there's decline in property sector, there's also decline in the downstream sectors as a result. or upstream sectors as a result. And then energy shortage will no longer be a problem. That would be positive contribution to economic growth. And then for infrastructure, there will be improvement gradually. If you look at fiscal policies, there is room and there is the will to see improvement. So in the past 2 months, we have seen changes already in government policy. So they would like to put in place more proactive fiscal policy. And there would be faster issuance of local government debts, and projects approval will be accelerated. So for infrastructural investment in Q4, I think there will be positive growth. And there would be even more significant outcome in March next year. What will happen with the property sector? I will say a bit more. I think that in Q4 and Q1 of next year, there will still be a decline in the property sector. Next year, in the second half, we will see some stability. On this slide, you can see a few charts about consumption. Well, we have done a consumer survey, and there are two numbers that I would like to share with you. First, because of the pandemic, if you look at the labor market, it has still not recovered to the pre-pandemic level. So income growth still has not resumed normal. And then besides, people's savings rate is very high because people dare not spend too much money. So savings rate is higher than in 2020. So this is a factor impacting consumption a lot. Next year, if the pandemic is alleviated, then some demand will be released. So that's one main factor. Besides, the employment market is still facing pressure, especially in the construction sector. In Q3, according to our survey, in the construction sector, there was weakening in the propensity to hire people, and the situation in the future will not be very optimistic. Construction industry is very labor intensive. Because of a decline in the property market, the construction industry also faces pressure. So that's about next year. And then regarding energy and power shortage, I said just now that in the short term, there will be impact on price. However, our judgment is that actually coal price is already coming down, and because of power shortage, well, we believe that we will see a turning point soon. As regards impact on inflation, within a short period of time, PPI was pushed up because of power shortage. And in the coming few months, there would be a decline in PPI. For next year, we believe that there would be a 2% or 1 to 2% growth for CPI because upstream price is being passed on to downstream, and food price, pork price, starts to stabilize. Before and after festival, there would be a rebound. So next year, CPI will go up, PPI will come down. For CPI, it will not increase too much. Next year, we believe that there will be an average growth of 2%. So for monetary and macro policies, the impact will be limited. And then globally speaking, I think we are going to be the first to show a weaker sign in inflation. And then for infrastructure, there is fast decline, but in the future, things will gradually recover. Now I will talk a bit more about the property sector. The decline in the property sector is driven by many factors. Recently, in the past few months, because of China Evergrande, people paid a lot of attention to the company as well as the impact on the overall property sector. So the decline is due to fundamental reason and also some other factors. So let's talk about fundamentals first. First, demographic structure is changing. So there is a decline in the percentage of people buying property. In the past, there was not a clear decline in demand, but then in 2016, 2017, and 2018, there was the monetary reform, and as a result, the housing demand was artificially pushed up. After the end of the reform, the actual demand went back to a level closer to reality. And then there's urbanization. Pace of urbanization is slowing down. And then our payment capacity and also people's debt level is rising. These are the fundamentals. And there are also policy adjustments. For policy adjustment, last year, there were the 3 red lines. This year, there is an upper limit on credit for property. There are controls about mortgage starting from Q2 this year especially. And then there is also the China Evergrande incident. So what will be the impact on the Chinese economy? If you refer to this input-output chart, 1/4 of China's GDP is related to property market. So 1/4 of the consumption is eventually related to property. And then this is related to, for example, iron and steel, cement. These are most related to the property sector. If you add them all up, around 25% of the total. In the past 10 or 20 years, the property sector was the main growth engine. But then recently, this engine has become less important. And next year, I think there will be a big negative effect. If you turn to other factors about the property sector, for example, local government, finance, and also other industries like iron and steel, cement, automobile, home appliances, and so on, there's also big impact. So because of such huge impact, one more thing. The property sector also impacts the finance sector a lot. So we can make an estimate. If you look at the banking sector's total credit for property developers, and then trust and also off-balance sheet items, well, there are many non-property related loans that are backed or guaranteed by land and properties for Chinese banks. So 50% of the loans are actually related to the property sector. So this is a very big risk exposure. So we can make a judgment about policy. And what is that judgment? The Chinese government's bottom line in relation to the property sector is not that all those 3 lines have to be complied with or to achieve common prosperity by means of the property sector. Actually, the government wants to see stable and healthy development of the sector. If price soars and if there is bubble-like development, then the government will intervene. And on the other hand, if the situation stabilizes, regulation or control will be relaxed. I think the government wants to make sure that there is not a hard landing in the property sector. Otherwise, there would be huge risk to the overall economy. And because of the close relationship between the property sector and other sectors, I think the government is going to adopt a pragmatic stance and not dogmatic. So that's why many investors asked about the Chinese government's bottom line. Will the government allow a collapse in the property sector? No, I don't think so. Our prediction is that in Q4, property sale and new construction commencement would decline by like 15%. In Q1 next year, there would be a bigger year-on-year decline. But then on a quarter-on-quarter basis, after Q1, things will stabilize. So there are a few factors. Comparing with 2014, 2015, decline in the property sector. Now, inventory level is low all over the country. So downside may not be as big. Comparing with 2014 and 2015, Upstream industries like iron and steel, coal and cement, the excess capacity is not as big. If you refer to PPI in 2015, China experienced 4 years of deflation. However, if you look at these industries now, actually supply and demand is very tight. So when it comes to collateral damage, I think it is smaller. And at present, there won't be the room as in 2016 to 2018 where there could be a large-scale monetary reform to push up the level. So the decline will not be as deep. However, please do not have the expectation that it will reverse soon, that it will rebound strongly. Our judgment is that next year, property sale will decline in area by 10%, for new commencement 10 to 12%, and property investment down by 5%. So next year, estimated GDP growth will then be around 4%. And then for policies, the outlook is this. Fiscal policy is now being relaxed. In the future, when economic decline puts a greater pressure, then there will be greater pressure on fiscal policy relaxation. For example, local government debt issuance will be accelerated, and then bonds and other projects would be implemented. It will be implemented in an advanced manner. And then we are still waiting for lowering of RRR. Well, the central bank has not made that announcement, but when there is pressure of economic downturn, I think the central bank will also face pressure. And right now, for green and carbon reduction tools, there are not enough. And then for credit policy, for monetary policy, apart from liquidity, there is also credit control. For example, mortgage control, development loan control, credit control with regards to local government financing, and so on. So I think that would be relaxation for these tools. Credit will be extended out. So that will be a monetary multiplier. So our estimate is that credit growth will bottom up in October, November, and then next year, there would be a small releveraging. This year, there is a decrease of 8% in terms of deleveraging, and then next year, there would be an increase of 4 to 5%, so mini releveraging. So all these policies together can make sure that our economy will not see a hard landing, and there would be a growth of about 5%. For property policies, I already said that the government is pragmatic. So there may be some loosening along the periphery, but then we should not expect the government to stimulate the property sector in a large way. But for property loans and also interbank markets, refinancing, I think there would be some relaxation about mortgage as well. And then local governments will increase building of rental housing. I think the government is more concerned about the macro instead of the future of one or two property developers. So I think the point is to guard against hard landing in the property sector. So I will now spend 1 minute to go through the next part about regulation and common prosperity. China's regulation, to a large extent, is trying to compensate or fill past loopholes. And there are other considerations, for example, information security, national security, social fairness, and so on. Overall speaking, I believe that there would be more opening up, support for high-tech industry and digitization development. I think this trend will not change. However, for different sectors and industries, there would be some adjustment, and some adjustment will be painful. But I don't think there will be any change in the overall economic trend. With regards to common prosperity, actually during the 18th plenary session in 2012, this concept was introduced, but now there's the need for action plan and more concrete actions or measures. The overall direction does not change much. Recently, the media pay more attention to redistribution, that is third distribution. But then for the common prosperity concept, first there is the first distribution or primary distribution, so support for employment, support for service industry, and income growth, people's income growth, especially for the laborers. And then for redistribution, I think there would be an increase in provision of public services and social security coverage, especially for the agricultural villages and tier 3, 4, 5 areas or cities, low-end cities. Because for public services and social security, well, things are not fair among different groups, especially for migrant workers. So I think there would be more supply in these areas. The government will increase spending, especially local government spending. And then for tax reform, I think it is going to be gradual. It will not happen immediately. There would not be a big change about redistribution from the tax point of view. For property tax, well, there would be a 5-year pilot scheme in different places. So in other words, in the coming 5 years, there would not be a national property tax. It will just be a pilot stage. That's all from me. Thank you. Thank you very much, Dr. Wang. Now let's invite Dr. Helen QIAO to speak. Thank you very much for giving me this opportunity to attend this conference. Despite the pandemic, this conference is still being organized annually. So through this opportunity, I hope that I can share with you our views about the China economy, especially what will happen next year and in the medium to long term. So I will talk about dual circulations. And I would also offer some policy recommendations. To a large extent, our direction is very close to Dr. Wang's. Every year, when we sit here to talk about China macroeconomic trend and outlook, very often we can see that our views are very close to those of Dr. Wang. This year, we tend to be more conservative. If you look at relaxation of policy, yes, there is more room. But now, if you look at policy adjustment coverage, there is still room for improvement. In the short run, we believe that there is still big decline pressure in the economy. So what is the source of such downward pressure? Well, our views are exactly the same as Dr. Wang's, so I'm not going to repeat the points. And Dr. Wang also analyzed the risk factors in detail, so she has given us a very good start. So why are we more conservative concerning the downward pressure? Starting from Q4 of this year, if you look at the growth rate, GDP growth rate will be on a lower level on a year-on-year basis, but then there will be significant improvement from Q3. In Q3, there was short-term impact caused by the pandemic. In Q4, there is some marginal relaxation about policies. So we have more confidence in the quarter-on-quarter growth. But for next year, even though in Q4 this year, there is improvement from Q3, but next year in the first half, in Q1, Q2, we believe that the quarter-on-quarter growth will be around 4 to 5%, and in the second half, 5 to 6%. If that's true, then for the whole year, growth rates will not reach 5%. You may not be able to accept this impact on China's GDP growth. Well, we haven't seen more comfort from policies so far, so we need to be psychologically prepared to accept this growth rate at 4-odd%. So concerning growth rate for next year, I won't repeat the points about the three carriages, so to speak, and also the source of such developments, and also pressure from policies on the market. Let's analyze from another angle. So recently, if you look at the things that happen, are they a paradigm shift, or do they form a cycle really? If we refer to these two curves, they are economic indices created by us. Activity coincidence tracker. So it is the orange curve. On this slide, the orange curve means growth, and it replaces GDP. So it is on a month-to-month basis. And actually, we have selected some economic activity indices to form this curve. But then in GDP, there are some factors that cannot be judged whether it is going up or down. For example, the service industry consumption. So what is the result? With this composite index, we hope that we can come up with a different explanation. And the biggest help is that from the past till now, from a historical point of view, we can do an analysis of economic change.
And you'll be able to see the August numbers. And September, 1.5%, as you can see from the chart. And at these levels, what does it mean? Compared to first quarter of 2020, when the epidemic was at its height, it is indeed better. But under normal situation, that is where the base situation is stable without epidemic and close downs, this number is actually pretty grave. One can say that compared to 2018, 2019, it is not as good. So last year, at this point, it was a special situation. Now, if we look at the blue line, that is a financial condition indicator line. And this is the exchange rate and also the interest rate and also some of the other rates that we have integrated together to come up with this blue line. So the blue line is a policy cycle. And when we put the orange and the blue line together, we say that the financial line is leading the orange line. That is to say, if the financial situation can be loosened, only then we will be able to see the other line improving as well. But that has not happened. The latest updated October numbers that has come out is level with the September number. So the lower the blue line, it is more strict, the financial policies and situation. So we see where the blue line is at its last point. It shows that in the past 15 years to 20 years, relatively saying, it is tight. The financial situation is relatively tight comparatively. And with the economic growth slowing down, what should the policy be? And there are certain adjustments and minor adjustments from the policy bureaus, but at present, should it be a counter-cyclical policy, or should it still be a adjustment or minor adjustment situation? We think that minor adjustments are no longer sufficient. Together with Dr. Wang, I also believe that there should be loosening policies, including the lowering of RR and lowering of interest rates, perhaps not in big ways all at once, but gradually. And also the market signaling is important with the lowering of interest rates. So that is a background, and you may have a lot of questions engendered. Why wait until now before action is taken? Is it waiting for GDP to lower to 2% or 3% before taking action? And PPI is too high, is that right? Is it going to lower to 8 or 6 before there can be action taken? Or unemployment is in the urban areas going up to 6%, 8% before action is taken? It's hard to answer these questions, because if we look at the past cycles, overall speaking, the past cycles, even before it reaches the present situation, action would have been taken. But action had not been taken this time. So we are adjusting our psychological expectations, and when it touches a certain point, a certain number, then action will be taken. But I don't think that is the case anymore. As Dr. Wang has pointed out just now, this is not cyclical, but a paradigm shift. Some of the mid to long-term objectives have been made evident, and this is no longer the paramount importance of the prosperity. It's about common prosperity, and it's also about property and also medical and health, these issues that are very important in the hearts of the people at large. These will have to be addressed, and other important issues in livelihood. So at this point, why have we, that is for this year's policy, it is still stringent. It's not loosened. There are some technical reasons for it. Short-term-wise, last year with the epidemic till now, for policies, there had been some complacency. And this complacency stems from the good control of the epidemic, and also in the first half of the year, the GDP growth had been high. Some people say it is because of low base, but it is relatively high nonetheless. And there are two other technical factors as well. One, the overall next year, before there's a change of government, that there should be a risk avoidance. So risk avoidance is lowering growth, because for risk, the tolerance for risk, it is now lower. So there is no risk appetite at all. So from the policy or the regulators, it is a low risk policy. It's like a child. You're afraid that it will have accidents. So what do? Avoid it from moving around. So you tie him or her up. So that is a situation. But there are other risks engendered. And another is the local governments. The other factor is that the local governments and the ministries, they have this propensity, and that is, once they have a policy direction, they will come up with this policy and then see that it is, not effective enough, and the next day they come up with another policy in the same direction, and then another policy in the same direction again. So that may be an overstrong in terms of policy. So we do see that there is overstrong implementation for certain policies. End of September, there had been certain changes. And at the end of September, what we saw is that with the banking, the PBOC and the Banking Commission, they requested that there should be certain changes to the policies. We already saw a little bit of that action. And when we saw the numbers coming out yesterday, the property sector, mortgage credit had been loosening. So that's also happened. And this morning, we see a lot of media reports are saying this, and that is central bank is saying that everybody should be looking at the yesterday's numbers positively, and that is credit numbers have been increasing, the cases have been increasing compared to the month before. And the existing volume, it has not changed, but the newly added cases for credit had increased. So that's loosening up. That's the argument. But while we see this, we see still declines in the other numbers. We don't have time to talk about all these now. For Dr. Wang had been talking about that by the end of year, there would be certain improvements, but in September it was 10%, and October it was also 10%. And for structurally, we see that for mid to long-term enterprise credit, it was even worse than September. And so that was the October numbers. So the financial system is not able to help or support the real economy. So how can we see that the blue line coming up? It may well go down rather than what we need to see, an improvement. It may not appear. So we think that there should be more loosening up. So next year, we would want to see more policy loosening up, and there is indeed room for relaxation of policies. And another point is export. Next year, it is not a particularly it cannot be like this year, relying on external circulation. It will, for next year, it will be high in the beginning and low in the at the end kind of export situation. So it will be a positive growth for export, but it is not going to be a very positive growth. Rather, it may be a decline next year. And also from risk avoidance point of view, short term, inflation risk is limited. CPI and energy price and food price, there had been certain fluctuations, but it's not effective or not consequential. And from growth point of view, our judgment is that for property, its importance, as Dr. Wang had mentioned just now, we cannot overlook it. Our estimate is that property for GDP from upstream to downstream is 28.7%. And this is from Harvard University. They also have come up to the same number, 28-something%. So if we do not see other policies, like the policy in Shenyang, for example, taking away the limitation to of purchase, and also the identification of certain credit for multiple purchases, etc. We think that with the loosening up of these policies, there can be an avoidance of risk, rather than to have these risks increase because of further tightening. Thank you. Dr. Chow. Next, we will have Dr. Well, good afternoon to you. Very happy to have this opportunity to share with you the Greater Bay Area and also the Hong Kong Financial Center and some of the changes therein. I'm going to talk about four main areas. Recently, you know about there had been the Bond Connect and also Wealth Connect. These are relatively new. In September, Southbound, now Bond Connect and Wealth Management Connect had already been opened up. And it is a completion of the flow of the finance And this is something that is important for the investors as the policies open up a new channel for investment for domestic investors. And in October, we see that there was the opening of Wealth Management Connect. And for the Greater Bay Area residents, it is a relaxation of the capital accounts of the investors or residents of the mainland and in the Greater Bay Area. Since 2019, there had been the preparation for this over 2.5 years has transpired, and finally, Wealth Management Connect had been opened up. And for Hong Kong, it is bringing on more opportunities. That is for Hong Kong investors to go up north in investment, and also for the Greater Bay Area residents and investors to come down south. So with these, now if we compare orange to apple, these two developments, I would say, for China mainland, it is a step in capital opening up. And to have the Greater Bay Area leading in the connects is the policy. And in timing, there is a difference in the sense that for Wealth Management Connect, it is really bringing on a new time for individual investors, a new era. And for Bond Connect, it is more institutional investors related. And the wealth management products are really mid to low risk products as a first stage. And the individual investors also have a certain quota, and also they are differences in terms of the investment mode for individual investors versus institutional investors. But in any case, for the capital markets opening up to institutions and opening up to individuals, with these connects opening up, it is indeed a new era. So the overall financial market, regulation, development, etc., have provided more confidence that there will be more further opening up of the capital markets. In the past, it's always been talked about that the capital accounts opening up will be gradual, and that's indeed coming. So macro speaking, this is significant in the sense that it is going to further promote Hong Kong's connection or connectivity with the Greater Bay Area. We see Bond Connect and also Southbound Bond Connect. It's going to bring onto Hong Kong bond market more funds from the north. And also there will be more financing activities from different enterprises or companies in Hong Kong. And for Wealth Management Connect, it also has its own developments. Domestic investors can go through the banks to purchase or invest in Hong Kong wealth management products. And there will be more connectivity between the domestic and overseas capital markets. So for this time, it is opening up the GBA, the Greater Bay Area markets. But overall speaking, the feeling is that with the capital accounts opening up as a trend, there will be regional opening up as well after the GBA. So GBA is leading some of the other regions in the mainland, for example, in the policies and the implementation of the policies. There are more piloting opportunities in the GBA area. So why pick GBA as the pilot? We see that in the GBA financial development guidelines, it says very clearly that there are certain very grand designs for the GBA financial business. One, it is to grow the financial system and size in the GBA area, and it is significant for the country. So we can see that for GBA financial industry in the mainland, it is large as a proportion of it, and there are a lot of financial institutions in the GBA area, and it is very vibrant. And also behind that, we also see that there is a development of the service industry and service economy, and this is where GBA excels as well. So it has a very strong base in terms of innovation, high-end service, and high-end manufacturing. GBA is leading the rest of the country in these areas. And we see this diagram here. The GBA at present, it has 3 exchanges, the Hong Kong Exchange, the Shenzhen Stock Exchange, and also the China Emission Exchange situated in Guangzhou. So this is rare in the sense that it has the common law trading system and also the mainland legal system-based stock exchange. So in this area, there are 2 legal systems, and they are traditional exchanges as well as a green exchange in the form of the emissions exchange. So this is a demonstrative effect that it is showing in the GBA area. So as the financial market is promoted in its development in the GBA area, in that process, there are certain relationships with the relevant areas. For instance, in the Wealth Management Connect, the Northbound, Southbound, Stock and Bond Connect, it is really radiating the development and innovation in the area. And also from the how it started to capital accounts opening, and in the midst, the connection of stocks and also bonds trading. So this is looked upon as a process that will bring on the liberalization of RMB. So that is from the macro point of view. From a micro point of view, in terms of the institutions themselves, the Bond Connect and also the Wealth Management Connect, etc., it is materializing a cross-border resources high efficiency matching. So Southbound Connect is providing more possibilities and convenience for companies issuing bonds and attracting mainland funds. And this is a new attempt, and it would bring on a cross-border convenience in investment for the GBA area and for Hong Kong. So for Hong Kong wealth management customers, it has all of a sudden extended from 7 million, which is a population of Hong Kong, to 70 million, which is a population of the GBA overall. So this is a very positive development for the wealth management industry in Hong Kong. So we see that for wealth management and AUM for Hong Kong in the past 2 years, it had kicked the market trend, and it had been on the increase in the past 2 years. And also, offshore wealth management activities have been increasing. The demand had been increasing, and Hong Kong as an international wealth management center has been brought more opportunities, especially with the trend of RMB liberalization. So that is evident. And also, mainland investors in the Hong Kong market had been increasing as a share of the total. So with all these factors and all these measures and all these policies, it points to Hong Kong as a choice and increasing Hong Kong's role as an international financial center. Not too long ago, there had been promulgated the London, there is a survey in London about the position of financial centers around the world, and Hong Kong has climbed back up to number 3. But it is still quite a distance from the top 2 international financial centers around the world. And among the major international financial centers in terms of human resources, in terms of infrastructure of the market, and also the development of the financial sector and some of the related legal systems, etc. Hong Kong has major advantages in all these areas. And we feel that Hong Kong, as an international financial center, offshore RMB hub, is a very important component of it. So RMB business basically is providing a very core competitiveness for Hong Kong as an international financial center. In the past 10 years, in its changes with the internationalization of RMB at every step, Hong Kong had a role to play in promoting the market for that. Hong Kong had been very proactive all through. So we see the dual circulation and the development of domestic policy changes and loosening up. With dual circulation, the mainland regulators have a deeper and higher expectation of Hong Kong as an international financial center. So Hong Kong is not only going to lead in the GBA area, but also in the entire country's opening up in finance. Hong Kong will have a bigger role to play in its spearheading role. So Hong Kong is still number 3 in international financial center position. And we see that there will be further opportunities of enhancement going into the future. I have mentioned, for instance, the Wealth Management Connect, Southbound Bond Connect, etc. And as these policies are put into place, there are still a lot of room for further enhancement. For example, cross-border investment and financing in GBA, in terms of the processes, there can be further streamlining. And we can also learn from the EU passport system, whereby financial institutions in the GBA area can be registered in one single place and be able to come under the regulation of the regulators of both sides, Hong Kong and the mainland. And with that system, allow these financial institutions to extend their business and coverage. So in the GBA area compared to other regions in the mainland, it will be easier to achieve these ends. Apart from GBA spearheading the developments, Hong Kong as an international financial center has a very important meaning for the country as a whole. And that is in connecting up with other areas. For example, in Hainan, there is the free trade port establishment, and that it had modeled after Hong Kong. So free trade zones, free trade ports, they have transferred or copied some of the Hong Kong regulatory measures, etc., into practice. So in the opening up of China financial market and trade to the international arena, Hong Kong will be able to play that role of innovation, of integration, and model for systems, measures, and also marketization and regulations. So this is what I want to share. Thank you. Thank you very much. Next, we have Mr. Yao. Good afternoon to you. Very honored to have this opportunity to join this seminar. And today, I will be talking about something that is quite related with what Mr. Long had talked about in the morning. We see there is a major surprise in the macroeconomy, and that is the rapid introduction of policies in the macroeconomy. Those are surprises. And how do we see the change in the logic of policies and regulation, and how does it relate to the concept of common prosperity that we've talked about? I will be talking about that. And this is a 15-minute presentation. Maybe I will throw a few questions out. First of all, how do we read and understand the regulatory storm that we have seen recently? What are some of the intentions, policy intentions behind? And what about common prosperity? How is it going to affect policies? And in pursuing common prosperity, how would it bring on changes to the regulatory environment and macro policies? And also, with common prosperity, what are some of the market opportunities and challenges? In the past 1 year, we see some of the policies coming out, major policies. And if we categorize them for the major policies, they come under 4 categories. Now, because of limitation of time, I'll be very brisk in going through them broadly. One of which is the lowering of systemic risk. And the affected industries are fintech and also property sector. And financing is a very clear example, the IPO that happened last year. And the other is anti-monopoly. In this area, we know that China lags behind the US and EU. And there had been a vacuum in law for anti-monopoly. And last year, because of that vacuum and the period before, there had been certain confusions because of the vacuum. So we have seen some development in this. For example, in the major technological platforms, they have been affected. And the third category is data and national security. So these are the affected companies or enterprises are the companies that have a lot of data with them. And the fourth category is about population and also social parity. And this would include the education sector that had been affected. So in the past period of time, we see that in a number of areas and a number of levels, there had been new policies coming out. For investors, they had impacted them much. And for the China market, the investors feel that there had been major disruptions because of these policies. Now, the linkage among the policies superficially, there is not much linkage among them. But at the back of it, they are actually coordinated. Then there is a common logic. And I feel that the logic is that there is a mid to long-term growth model, which is new.
Then an issue comes. Why do we need common prosperity? What does it represent? If we imagine this morning, we can still remember Mr. Long's speech. In the past 40 years of economic development in China, huge wealth was created. However, there are problems with distribution of the wealth. If we look at the left-hand chart, income distribution in China is showing a pyramid shape. A small group of people are at the top of the pyramid. They grasp most resources in society. In China, there were 600 million workers every month earning less than 1,000 RMB per month. If we add up the lowest layer and the top layer, 70% of population earn less than 2,000 RMB per month. So actually, right now in China, there is a very wide wealth gap. And on the right, there are 2 charts. So you can see changes in Gini coefficient. The top 10% and the bottom 50% of population in the past few decades have experienced change in their income and assets. So the wealth gap is widening. In the past 10 years, the government put in a lot of effort to change this deterioration. Starting 2021, China started a big strategy, and that is precise poverty alleviation. So in today's context, what is the goal of poverty, of precise poverty alleviation? In fact, the government would like to narrow down the lowest layer of the pyramid, and that is, it is hoped that the low-income group can earn higher income. So actually, last year, we heard this concept, common prosperity, in many speeches and documents of the government. This term is used. So we can see common prosperity concept as an extension of precise poverty alleviation. We want to decrease the size of the lowest layer of the pyramid, and we want to redistribute the resources at the top of the pyramid towards the lower level. The two strategies together have a common goal, and that is redistribution of resources should take the form of an olive instead of a pyramid, with a bigger middle part and smaller two ends. So we're talking about redistribution of resources. And then if we look back the past 1 year, in China, there are many changes in policies. So the reason why the property sector has to be regulated, well, in Tier 1 city in China, is like Hong Kong. So those with properties are at the top of the pyramid, those without are at the bottom. And the property bubble is increasing in size. As a result, the wealth gap is also widening at the same time in China. So for this particular industry, there is change in policy as well as attitude, and this is long-term in nature. Of course, there is default case like China Evergrande within the short run, but the long-term strategies will not be changed. The reason why the tech industry has to be regulated and suppressed, because there is huge degree of monopoly of resources. We see a lot of vicious competition, crazy expansion, and also the haphazard charge of platform fee. If we use Giant's platform company as an example, additional dollar or additional yuan charged by the giant companies will not flow to the SMEs or companies using the platform to do business. For the low to medium income earners, they won't benefit. Small companies won't benefit. So the giants are monopolizing the resources. As a result, it is difficult for resources to flow from the top of society to SMEs or to the lower downstream. So this policy change is a must. Why do we want to do something with some other industries? Because in the past few years, we can see that they expand a lot. So in the past, they were in, for example, extracurricular activities like singing, dancing, but now there is a tutoring service for major academic subjects. So education resources are being unevenly distributed. Wealthy families can send their children to ECA tutorial classes, and these children receive a lot more resources than poorer children. As a result, upward mobility channels for the lower class youths are actually closed. So in face of this pattern or trend, the Chinese government made immediate move. I don't see any problem with that. So perhaps we can discuss whether the broad-brushed approach or the strong one-off approach is good. But then in my understanding, we are talking about redistribution of resources. And with this concept, we can understand in greater detail, changes in policies and formulation of policy. Okay, we have started this strategy about common prosperity. For this goal, it is going to be multi-year or multi-decade. It can't be achieved within a short period of time. So in the future, definitely there will be more policies and regulations coming up. And there are 3 policies that we should pay attention to. First, redistribution of income and wealth. And we think that the secondary distribution is more important. If you look at the tax system of China, there are many loopholes. Tax imposed against the wealthy are not adequate. We do not have real estate, we do not have inheritance tax or estate duty, and there is no capital gain tax on equity. And then, well, property tax is being tried out now. In the coming 10 odd years, I think systemic loopholes will be gradually filled. And then the second dimension is social security. Every year, in relation to social security, the spending accounts for 9% of GDP in China. For OECD countries, the average is 21%. So we still lag behind OECD countries. If you look at the middle chart, in the past decades, our economic development growth rate was put on top priority. As a result, soft infrastructure like social security investment is relatively lagging behind as compared to hard infrastructure. But I think right now the gap between these two will narrow. And then the third dimension is fair allocation and distribution. One important concept is common prosperity. So it does not mean robbing the rich to help the poor. So common prosperity means that the opportunities to create wealth should be fairer. Rich people, poor people, small and big enterprises should compete on a level playing field. We are not talking about equal distribution of wealth, but equal distribution of opportunities. So if there is monopoly, then there will be an anti-monopoly system. And if there is unfair competition in certain sector, then definitely there would be some follow-up actions. We have to work hard towards common prosperity. However, is this goal worth our effort for so many years? I would like to make 2 points. What can common prosperity bring to us? Internationally speaking, there is a consensus already, and that is when a country's wealth gap widens, it will stifle economic growth rate of the country. So by means of common prosperity strategies, if wealth gap can narrow, then China economic growth rate can become faster. In other words, the whole pie will be bigger. Second, the economic structure should be optimized. Our consumption share of GDP is too low in China. And this is related to the wealth gap because so much wealth and income is concentrated in the hands of the wealthy, and their marginal propensity to consume is much lower than the low to medium income earners. So that's why consumption is being stifled. If more income is distributed to the low to medium income earners, then the overall consumption can account for a bigger share. Now, if we look at the financial sector in China, banks are the dominant players. And if they give out loans, they need collaterals. And usually collaterals are real estate or properties. And if these are concentrated in the hands of the wealthy, then if low to medium income earners want to consume or start business, then they do not have any collaterals available to support their borrowing. So we have to tackle this issue. Apart from the macro dimension, we know that wealth gap is not unique to China. In many advanced countries, if we refer to the Gini coefficient of wealth and pre-tax Gini coefficient, many countries are higher than China. And this doesn't only impact the real economy. There will also be impact on social divisiveness. Well, Trump was elected in the U.S. because of uneven distribution of wealth. So we think that this is closely related to social stability as a long-term goal. Finally, I would like to talk about challenges. Well, this journey of transformation will not be a very smooth and short one. So I would like to talk about two balances. The first one, how to balance the two things. On one hand, we want to make the pie bigger. On the other side, we want to share the pie well. So our per capita income is not even 1/6 of that of the US. So we cannot give up our goal of economic development. We cannot just concentrate only on social welfare. So first of all, we talk about common prosperity. So let's create wealth first, and then we should divide it up in a better way. So how do we strike a balance between these two? So common prosperity is on one hand, and the other hand is the dual circulation. So to strike a balance is the challenge of the central government. And the other balance is short-term macro stability and also sustainable development for medium to long term. For the medium to long-term goal, China is trying to, for example, suppress the property sector, tech sector, and also the education sector. And then there is already blow being dealt to the finance market. So how do we guard against and keep the side effects under control? This is a challenge for the central government. Finally, a conclusion. At the beginning of my presentation, I raised 4 fundamental questions, and then I gave short answers. First, how do we understand this regulatory wave in China? In the past 1 year or so, China introduced some regulatory change, and the change shows that now China is experiencing change. So Mr. Deng Xiaoping wanted to make the pie bigger. He wanted to allow some people to get rich first. And then now we need to strike a balance between a bigger pie and dividing up the pie in a better way. Now, common prosperity is an extension of precise poverty alleviation. We want to decrease the size of the base of the pyramid. For common prosperity, the resources at the top of the pyramid should be redistributed towards the bottom. And with these two strategies, the medium-term goal is that resource distribution in China should take the form of an olive instead of a pyramid. And then for future macro policy change, I think there are 3 changes. First, by means of taxation, there should be redistribution of income and wealth. Secondly, social security should be enhanced. Number 3, in all different sectors, there should be promotion of fairness and level playing field, equal opportunities and reallocation of opportunities. And finally, what opportunities and challenges will common prosperity bring to the economy? If we can successfully decrease the wealth gap or reduce the wealth gap, then our economic structure can be optimized. At the same time, social harmony and people's livelihood can also be enhanced. But we need to balance the challenge. And there are 2 balances here. So on one hand, a bigger pie and dividing up the pie in a good way. Second, short-term economic stability on one hand, and on the other hand, medium to long-term sustainable development. So, all right, that's all from me. Thank you very much. Thank you. Next, David, please. Good afternoon. I am David Wang from Credit Suisse. So greetings from me to all online participants. I am a newcomer in this conference. Thank you for inviting me. So please give me more of your input and comments. Now I am a new face here. So Dr. Wang and Dr. QIAO made their presentation, and both of them talked about the bank's outlook in relation to the Chinese economy, and then they discussed this theme. Now, my presentation will focus on the property sector. So let me also spend 1 to 2 minutes to talk about Credit Suisse views concerning the macroeconomy and its outlook next year. I won't repeat points already made because time is valuable. I just want to make 1 to 2 points that are quite different for your reference. First, concerning next year, slowing down in economic growth. Well, Dr. QIAO mentioned a growth rate at around 4%, and then Dr. Wang said 5-point-something%. We are more optimistic. Our estimate is 6.1%. So at the end of the day, will it be 6.1 or 6 or 5.9%? Of course, there will be some error in the estimate. We are optimistic, not because about the overall logic or exports, not because of a big discrepancy in our view. Well, apart from policy or policy relaxation, Credit Suisse and my assumption is that policy relaxation is going to be stronger as compared to the two other speakers. Next year, in the end of Q1 and early Q2, there will be less regulatory uncertainty. So in other words, my understanding is this. I am not in a position to represent the country. I only share my understanding. So the central government will make use of this year to build a new regulatory platform and framework as soon as possible. And there can't be any delay because in building a regulatory framework, there would be a lot of uncertainty for the real economy and market participants. And this is a disruptive force. Under these circumstances, if we look from the regulator or policymaker's point of view, this process should be completed as soon as possible. Then in the future, there will be a readjustment. Now, my estimate is that at the end of Q1 next year or early Q2, during that period of time, the new regulatory framework will basically be formed. It doesn't mean that from then on there won't be new regulatory policies or adjustments, but then the overall direction is being formed. And there would be less uncertainty. And then concerning the recovery of the real economy, or actually the real economy will experience some stimulative effect. If you look at monetary policy and fiscal policy, there will be some support. At least comparing with this year, things will be more relaxed. So that's why I'm more optimistic. Well, it doesn't mean that I have been all along optimistic. In Q1 this year, at the end of Q1 this year, Credit Suisse, well, I'm responsible for macro outlook in Credit Suisse, and our outlook is lower than the estimate. So many people said 9-point-something%, and we said 8%. So it is not true that all along I have been optimistic. So that's only my observation for your reference. Okay, I have spent 2 to 3 minutes on that already. So let me go back to today's theme, real estate sector. Let me share our thoughts. So in early July, we issued a report, and at that time, we talked about the real estate sector, and we were not optimistic. We were rather prudent and cautious. I won't repeat points already made by experts today, but we have done some quantitative analysis and we have created some models. Our conclusion is, at present, if you refer to average housing price, of course, there is pressure all over China on property price, but the pressure is not uniform. If we look at the aggregate dimension of the whole country, if you talk about the predictive or explanatory bubble, actually it is adjustment in demographic structure. The working class share of the total population. Of course, there are also other factors like disposable income and urbanization. So even if we have a more optimistic view about GDP growth in the coming 5-10 years, and then if urbanization will accelerate, even if we are more optimistic about future urbanization, if right now our labor force population share continues to decline by 8 percentage points, then average property price in China will come down. That means, well, it is not related to slower inflation or decline in growth rates, also including Tier 1 cities. I'm referring to the average. So if we observe each and every province and region in greater detail, in some provinces, if we are talking about already 8% for the working class age, then for these cities, they will face decline in housing price. Of course, in our report, well, we talked about when that will happen. It is difficult to say. It is easy to estimate demographic change. If you refer to this slide, if you refer to the dotted line, it is United Nations estimate or projection. And, well, this is public figure, public data. And if you compare United Nations prediction and the working age population trend in China, it is totally different. So the drop by 8 to 10 percentage points, comparing with United Nations estimates, well, our time comes faster in China. And the backward induction is very fast. When people realize this phenomenon, then the backward induction will lead to an adjustment, which will come a lot earlier. So from this point of view, we don't want to be overly pessimistic, but from policy point of view, our understanding is that the real estate sector is a sector that requires dedicated and constant policy attention. We cannot relax and we cannot just put it at the back. Given this macro environment, no matter whether we are talking about the near term or medium to long term, the real estate sector will bring about systemic risk to China. Of course, there are a few assumptions. Regulation has to be proactive, and there must be continuous attention by regulators on this sector. And we are not saying that things will go very wrong. No. When we communicate with clients, many of our clients are Westerners, and they said, okay, in the property sector of China, there is already excess capacity. Population will decrease in the future, but then all these houses have been built, and they presented a lot of figures to us. And recently, there's an academic paper presenting a lot of data that are quite reliable. So if you look at current supply, it is already huge. In China, most of the houses were built in the 80s and 90s. However, well, I also grew up in the States. So the Westerners are of the view that houses are still livable even after like 100 years, as long as there is good maintenance. So there will still be excess supply in that case. But then in China, when it comes to housing production in the 80s and 90s, no matter whether you consider the technology and use of materials, even though there is reasonable maintenance, well, these houses cannot be that durable. So there may be the need of renovation and redevelopment. And so as a result, the big decline in the real estate sector may be alleviated. So, okay, now let me turn to the finance sector. I have already showed you my underlying analysis. So from financial point of view, properties can serve as collaterals, and they are an important part of China's financial system. However, I don't think there will be systemic risk. The main reason is because of my judgment and projection of Chinese policies. I have run a lot of models and simulations, and I'm sure the central government has done even more such simulations. And issues that I can identify definitely can also be identified by the central government. So in terms of regulation and management and control, the government will guard against systemic risk. Finally, if we assume that there is no systemic financial risk, if the real estate sector continues to slow down or contract, the impact on China's real economy and the impact on the world, what will it be? Credit Suisse has done some analysis. If we look at construction in China, not only about houses in which people live, there are also other types of properties. The impact on Chinese real economy is huge. However, if you look at impact on foreign countries, the impact is very small. Of course, the precondition is that there is no systemic financial risk. If we only look at housing construction or real estate construction, let's say if there is a clear deceleration, the direct impact in terms of industrial production, value added on other foreign countries, if China's part is being excluded in industrial production value added, the impact on other countries is no more than 2%. So very controllable. 2 days ago, the Federal Reserve made some remarks about real estate sector of China. My understanding is that I hold different views. If we assume that there is systemic financial risk, then I agree. That would be huge impact on the world. But if our precondition is that there isn't any systemic financial risk, if there is only clear deceleration in the real estate sector or clear adjustment, then at least the first order impact is very manageable on other countries. Here's my last slide. If you are interested, even though we say that direct impact on other countries of the Chinese property sector is not big, you can still see that some countries have stronger reliance on China. Now, I won't read out all these countries, so that's all from me. Thank you very much. Thank you, experts, for the excellent analysis and presentation. So they have all done in-depth sharing. Because of time constraints, we only allow 5 minutes for Q&A. So Casey, you just said that you have a question. Please go ahead. Right, thank you. So after listening to all these presentations, I am thinking of an issue now. So we talked a lot about making the pie bigger or sharing the pie, and then working class population is shrinking. Well, this is already happening in China. In the past decades, in China, there was always a thought, where does China's economic growth come from? In the past, the working class was bigger, and so the whole pie was bigger. In the future, working population will shrink, and in the past years, well, all along, effect and outcome of basic investment has not been satisfactory. And in the future, for the medium term, in the past, there was the saying of maintaining 8% economic growth, and later on, 6% economic growth seems normal. And next year, an optimistic guess will be 6% or maybe 5% or 4-point-something%. IMF World Economic Outlook says that U.S. economic growth next year will be 5.2%, and next year for China, it will be more or less the same as the U.S. Of course, U.S. situation is different. For the medium term, right now, there has been more discussion on aging population. So in other words, aging population comes faster than creation of wealth and common prosperity. So what are your thoughts? Because of time, perhaps you can just answer in your seats. Let's do a survey here. Dr. Wang, what do you think? In the coming 10 years, from 2021 to 2030, average growth in China is 4.5% next year. It is coming down, now 5-point-something%. In 2030, below 4%. Average is 4.5%. So, as you said, working population is shrinking. This is one related factor. Well, in the past few years, working population was shrinking already. How come China could maintain economic growth? Because there is a shift in population. So there is a shift from low productivity area to high productivity area. So this shift has not ended. Besides, retirement age in China on average is 53-point-something years, which is low. Lifespan, average life expectancy in China is around 77. So if retirement age can be extended, that will be helpful. And then investment efficiency should also be enhanced. TFP, total factor productivity, in the future only sees limited growth potential. There's the need for more innovation, systemic innovation, and technological innovation. In the future, challenge is big. So average is around 4.5, and it is coming down. Dr. QIAO? Well, this is now under review. For long-term growth potential, we have not come up with any prediction. 2 years ago, we said that from 2021 to 2025, there would be 5.5 to 6% economic growth. with that level, right now there are two possibilities. So potential growth rate is still high, but now we are below that, so there's a gap. So there is some support for policy relaxation. Another possibility is long-term potential growth rate is coming down, not as high as expected. And we are now most worried that when policies change and when there are changes in control and management mechanism over the economy, if you look at investment, capital investment, labor, human resources, land, and so on, among all these changes, in the short run, we may see potential growth being lower behind capital investment. And then for TFP, usually, first of all, economy of scale. Second, technology advancement. Number three, factors of production, shifting from low productivity to high productivity sectors. And we think that the next change will be determined by policy stability and sentiment improvement. And right now, there is some pressure. Of course, we won't change prediction of long-term growth potential based on short-term policy change, but in the coming 2 to 3 years, there may be clearer prediction or judgment. In 2006, I wrote about the economy for the first time, and at that time, as Dr. Wang just said, population change pace is easy to judge. And right now, we exceeded the UNDP estimate, but for the short run, the downward pressure on the economy is only 0.1 to 0.2 percentage point every year. Not really big. I think a bigger impact will be from reform and policy end. So population change is not something that we are most worried about. Okay. Today, we focus a lot on adjustment and management of the property sector. We believe that it is a structural attitude change. Beijing has this structural attitude change. If you look at the real estate sector, I said in my presentation that it runs opposite to common prosperity. It widens the wealth gap. It is an amplifier. And if you look at the upstream industrial sector, they are the two biggest CO2 emitters in China. So Beijing now adopts a dual carbon strategy, and it is against the property sector. What kind of asset is real estate? It is unproductive asset. After the housing is being built, it doesn't create productivity. If we have the same resources to build a factory, it does create productivity and employment and jobs. So as the other two speakers said, they came up with like 25% or 30% estimate, that is resources going into the real estate sector, and it accounts for 70% of people's assets. With such a big part of unproductive assets, I think it is a long-term cancer for the Chinese economy. If we want to raise future GDP growth, then definitely we need to exercise some strong control over this sector so that resources can be reallocated out of the property sector to other sectors related to dual circulation. Only in that way can we have better increase in TFP going forward. All right, you will get the last word, right? Potential GDP in the coming 5 years should be 4.7%. So not much different from Dr. Wang. But she said that working population is shrinking. And if we want sustainable growth, then the only way is to increase marginal labor productivity. There are short-term, medium-term, long-term methods. In the short run, increase the capital labor ratio. Medium-term, education. We should enhance education quality, and this is something that the central government has started. I am confident in these two. For the long run, technological advancement. And I am a traditional economist. In many classical economic models, technological advancement is exogenously given, is something outside the models. What is the state's attitude now? My understanding is that we can endogenize it. So the biggest social experiment in this century is technological advancement. In the past, there is no experience telling us that technological advancement can somehow be endogenized. If it can really be done, then, well, I don't have strong conviction that this time we can really succeed. So, well, I hope that I am wrong. I hope I am wrong. I hope we can succeed. However, there is no basis to say that it will definitely succeed. So that's my point. Thank you, experts, for your sharing this morning. It is an excellent sharing. So we will conclude our morning session here, and we will come back at 2:30 for the afternoon session. I hope online participants will stay on. Thank you.